Okay. Good morning, everyone. I am Aluna Wang from HEC Paris. I'm the moderator today. So if you're in Europe at this moment like me, then I should say good afternoon to you. So welcome to the Accounting Design Project virtual meeting. Today, we are more than delighted to have Professor Wuyang Zhao share his insights. So Wuyang is the assistant professor of accounting at the University of Texas at Austin. His research explores the roles of short sellers and financial analysts in capital markets. Today, he will present his paper, Why Has PEAD Declined Over Time? The Role of Earnings News Persistence. So the whole seminar will last 1 hour. Here, I kindly ask all of our participants to hold your questions for the first 5 minutes to allow Wuyang to introduce the theme of his research. After that, please feel free to be active in this seminar with your questions, comments, and added insights. You can use the raise hand function, or you can just unmute yourself and jump in. And now the floor is yours, Wuyang.
Yeah.
Please take
Thank you,
lead.
Luna. Thank you. Also, I want to thank Ayang and Steve for giving me this great opportunity to share my research. I really appreciate it. And also thank you all for coming to help. So this is a joint work with my two colleagues at UT Austin, Laura Kettle and John McGinnis, and both of them are here. So later on, when I have super different questions, I will perhaps get help from them. And in particular, Laura is a fourth-year PhD student at UT Austin, and she will be on the market in the upcoming year. So if you are hiring, make sure that you check her profile, and I'm sure you will be interested. Okay, so let me get started. In a nutshell, so this is a paper about PEAD, or I would say PEAD, throughout the presentation, post-earnings announcement draft. So this is a paper about the decline of PEAD, and the most importantly, it is about a new explanation for the decline of the PEAD. Now, just in case you are not very familiar with the PEAD, so let me show you arguably, probably the most famous graph in the whole accounting literature. So this is from Ball and Brown, 1968. So you will see that, let me see what I can draw here. So you can see that when we separate firms reporting positive earnings news versus firms reporting negative or bad earnings news, we'll find that the price will drift in the direction of earnings news a little bit longer. So this is called post-earnings announcement drift. Okay, now let me provide a little bit background of this study. So PEAD is arguably the most researched anomaly in accounting. You might also mention accrual anomaly, but these two are very extensively researched in accounting and finance. So Pharma says that PEAD is the granddaddy of underreaction events, and according to a recent review paper on PEAD, there are more than 200 published papers on high-quality journals on PEAD, on the determinants, consequences, and implications. Let alone there are hundreds, if not thousands, of papers using PEAD as a way to test price efficiency. More recently, however, there are papers showing that PEAD has declined dramatically over the past several decades, and it's actually perhaps already disappeared. And according to our own data, if you look at as of year 2017, the PEAD disappeared. So there are already a few papers showing the decline and the disappearance of the PEAD. Now, if PEAD is really dead, and given all the attention, all the research, all the conversations we had about PEAD in the past several decades, I think it's really important for us to have an understanding on what is going on, what is the cause of the death of PEAD, right? Let's think about accrual anomaly, right? And Germa is here, and very glad you're here. And we'll know that, like, for the gun of accrual anomaly, and there are after your paper, there are multiple other papers showing different reasons why the accrual anomaly has declined and disappeared. And for the PEAD, at this point, we actually only have one prevailing explanation, that is the increased liquidity and the decrease in transaction cost make it much easier for arbitrageurs to trade on PEAD as an anomaly. and as a result, right, P declines and disappears. So in this paper, we propose a new explanation based on the persistence of earnings news. Now, just in case I don't have enough time to cover all my slides, so here is a summary of our findings. So we will have 4 sets of results. The first set is to just confirm the decline of PEAT. And then the second set is our core analysis, which is to show the role of persistence of earnings news. So we first show that the persistence of earnings news declined over time in the past several decades. And then we show that this persistence of earnings news is highly associated with PEAT. And most importantly, when we consider the persistence of earnings news, then we actually do not observe the declining trend of PEAT. In other words, the decline of PEAT is explained by the decline of persistence in earnings news. Now, we want to show this as a distinct explanation, in addition to and separate from the prevailing explanation, which is related to the arbitraging activities. So by doing that, we control various proxies for arbitraging activities, and we find our results still hold. And in addition, we show that, hey, perhaps you will argue it's quite noisy to capture arbitraging activities in the long side. It's much more accurate in the short side because we have relatively good short-selling data. And then we use a short leg and we find the same results. Finally, we conduct several sets of robustness check. So overall, the key takeaway and the key conclusion of the paper is that we document a key reason for the decline of PEAT is the declining persistence of earnings news. Excellent. Ite?
Yes, thank you. So I was wondering if what you have in mind is a decrease of earnings persistence or a decrease in investors' misconception of earning persistence. Because one of the issues that stands behind the PEAT is the investors' misconceptions of earning persistence.
Right.
And that's why I was wondering if what you have in mind is the decrease in earnings persistence per se, because earnings persistence could remain the same. However, it might be related to the change in investors' misconceptions of the persistence.
Right.
So if you can elaborate on that, thank you.
Right. So at this point, in the current form of the paper, what we do is the decline of the declining persistence of earnings changes. So it's two things I need to make it clear. The first one is we talk about the persistence of earnings news. So that is related, but different from the persistence of earnings per se. So this is the first thing. Second thing, related to the essence of your question. Yes, we are talking about the declining persistence of earnings news. Not at this point, in the current form of the paper, we didn't explore the declining the investors' perception of the declining of persistence. But we can have a more detailed discussion later when I show the empirical part.
I see. Just following that, is there a reason for that? Because you talked about Richardson, for instance, in 2010, and one of the claims in Richardson and all, I think most of the paper is that it relates to the investors' misconception of earnings persistence. So maybe you will talk about it later on, but I was wondering, why do you focus on the persistent itself and not on the investor's misconception of the persistent, which is the real a driver of the anomaly? But if you would like to talk about it later, then
right. So thank you for this. So the way we think about this is the declining persistence of earnings news, in some sense, is kind of the starting point, because if you have persistence there, and then the investor choose, or for whatever reasons they underreact, that can be one reason why we have PEAT in the first place. However, the existence of persistence itself is a necessary condition, right? If you don't have persistence in the first place, then you don't have underreaction, right? Because investors don't have enough, don't have things to react from. So in other words, in this sense, we view that declining persistence is kind of the starting point and is a necessary condition. And but to your point, I think we can definitely explore more to kind of go deep further to further separate and identify the impact from the declining perception of investors underreaction. We'll think a little more about that, but at this point, the way we think this is the declining persistence is a starting point and the necessary condition. Yeah, thank you.
Thank you.
Jeremiah.
Yeah, just a big picture question sort of related to this. There are lots of papers now showing one anomaly goes away, another anomaly goes away, or sort of lots of things don't predict returns anymore. Like it's getting harder and harder to predict returns. And so I wonder if in a bigger picture sense, you can think about that, because if in order for this to be sort of a meaningful contribution to that bigger literature, I think it would be nice to connect those together, right? Because I mean, I've been a proponent of the investors go arbitrage stuff for a while. And the reason I like that argument is because it helps explain why lots of things go away, not just a single anomaly. But I think there could be reasons why, so if persistence goes down and things are just less predictable now, that could apply to more than just PED. And so I think sort of thinking about, is this a general phenomenon that you're sort of documenting, or are you sort of talking about one little thing that you know happens to go away, but you can't really rule out other explanations? I think that would be really helpful.
Excellent, thank you, Jeremiah, for this question. So this is like a super high level question, which we talked about a lot in the very beginning stage of this project. So let me explain how we view this, right? So we, at this point, we really just want to focus on the PED for a couple of reasons. Again, first, the PED is itself super important. It's related to like thousands of papers by itself, right? So this is the first, and second thing is it provides a very tight setting for us to be able to kind of separate and identify different explanations. Now, if we think about all the anomalies together, then I agree with you, right? Like the arbitrary explanation can apply to everything. However, it's very difficult to figure out a viable alternative. Right now, this is related to your second part of your question, like, do we want to generalize to other things? Let me just pick up on the anomaly you are super familiar with, accrual anomaly. And correct me if I'm wrong on this issue. If we think about the persistence, right, it actually might have different implications for the PED and for the accrual anomaly in the following sense. So if we buy the story from Bernard and Thomas, 1989, so many of us will view that PED is an underreaction to the persistence of the suit, to the earnings change, the earnings news. So it's an underreaction story, right? Now, if we think about the accrual anomaly following Sloan, 1996, so it's more like a fixation on the accounting numbers. In other words, it's an overreaction story that the investors are overestimating the persistence of accruals, right? So, you already see some differences even between the accrual anomaly and the PED in this sense. So that is the reason why we later on, you know what, let's just focus on one thing and let's show in this specific setting that how much is contributed, how much of the decline is contributed by, let's say, the arbitrage explanation, which is the explanation that not underlying the PED, but also underlying a lot of other anomalies. Now, if we find in this setting that, you know what, the arbitrary explanation, the explaining power is not as big as we previously thought, then this might also have implication about the role of arbitrary explanation in many other anomalies. So in our approach is basically we take on a setting, a tight setting that we can, we know what's going on, we have a better confidence on what's going on, and then we just start from there and then try to be very careful in making implications about other anomalies. So I know this is a trade-off, and this is a very long answer, and there is definitely a trade-off between a narrow focus and a broad implication. but if you have any suggestions, advice on this issue, and we're more than happy to hear and to discuss.
Just one quick follow-up. Yeah, so I like your answer to that. I think it's great to say we need to focus on something we can closely look at. I think that's a great idea. I think, though, I like the next step we're saying, because I think in the publication process, my guess is, if you say, well, here's one of many other things, then it gets harder to publish. But I think if you say, if your purpose for focusing on it is to be very precise in what you analyze, and it could have implications more broad than this, I think that is more appealing than just saying, I'm just looking at this, right? Because I am convinced that there could be something related to this and other anomalies, right? So, but I guess I would say if it ended up being me as a reviewer, I would say, well, what does this tell me about other things? Whether this is a setting to look at things in general, but you're looking very closely at one thing, or if it's like the question is, we only care about P, then I think it's the incremental contribution is harder. But I think your answer sort of says we're specifically looking at P to be careful, not because that's the only thing we care about. So.
Perfect. Thank you so much. So this will be helpful not only for our framing, but also have one more paragraph in the contribution part. Thank you, Jeremiah. Yeah.
So I was just wondering why you haven't mentioned Bernard and Thomas yet.
Sorry?
Why haven't you mentioned Bernard and Thomas and the explicit link they draw between quarterly persistence and PEED?
Oh, right. Yeah. So Ayan, so can I move to the next slide? Because Sudipta's question is actually about the next slide. Or do you want to ask the question now?
No, that's good, but I mean, this is an explicit connection, because I think what makes PEED distinct from all the other anomalies is that we can not only predict the timing, which is at the earnings announcement date, but also the magnitude at future dates using Bernard and Thomas. This is different from every other anomaly, and it's the most persistent one, as Pharma 98 points out. So, but persistence is the critical part of that predictive part that we have for PEED that no other anomaly has.
Excellent, thank you, Sudipta. And I think in the earlier version, we did have this discussion about why and how the PEED is different from others, including this precise dates of the PEEDs, and which is mostly not available for other anomalies. And we had this, and I think we should bring this discussion back. And again, following Jeremiah's question, and kind of make this more broader and use this as a setting to test broader implications. Yeah, thank you. Ayan?
Yeah, I have two related questions. I think the persistence of earnings news declining over time, there's a literature in finance talking about idiosyncratic cash flow has declined or has increased. Idiosyncratic cash flow volatility has increased over time. Yeah. And that seems to kind of like consistent with your abstract or your new explanation that's another literature seems to already document there's a declining persistence of earnings news. Right. But when that's my first question. And then the second question is, but when I look at how you measure the persistence of earnings news, it's not just simply the autocorrelation across all the firms. Your persistence is only coming from your top decile and the bottom decile, right? So like you are looking at 20% of the listed firms at a given point in time, and how persistent their earnings or SUE is. Your measure actually do not have the middle 80%. So my question is that because those extreme firms somehow behave differently? And if we actually sort portfolios based on quintiles, try to kind of address the noises, whether do we also see the decline in PAD or the same? So it seems that there are two things going on. One is the declining persistence of the cash flow or earnings. The other one is just somehow the distribution of all the firms in the economy has fatter tails at both ends and driving the results. Yeah.
Right. Okay. Excellent. Thank you, Ayan, for this. And for the first question, you're talking about there's some trend about basically the cash flow volatility increased over time. And, you know, I guess we can look into that literature a little bit more, but the key message of that is actually also, you know, a few accounting papers which we cite, and I will talk about like in a few minutes in the hypothesis development part, and we're happy to include a little more on that dimension. The second one, so the way we measure the persistence at a high level is to look at whether these firms stay in their extreme deciles in the next quarter or not. So if you really think about that, that is actually quite close, if not exact the same to the way we usually measure like autocorrelation, right? So if you go back to Bernardo-Thomas 1990, and they have autocorrelations about the raw number, and they also have autocorrelations at the decile level, like the deciles of the previous quarter versus the decile of this quarter. So we are kind of like a simplified version of that. And the way we do that is actually because at the end of the day, we only focus on the top and bottom decile of the distribution. This is related to a second question. And the reason why we do that is because this is basically the way the prior literature measure heat. And I guess for many other anomalies, we just take the top and the bottom, either deciles or quintiles in some ways. And I think on this one, the one thing we can do is to at least to, let's say, create these portfolios using quintiles rather than deciles. However, the fact that the prior literature, which shows the decline of peat, is using deciles, and we have to follow that and explain why the peat based on these deciles, extreme deciles, decline, right? But to your point, right? We obviously we can do more and make the extreme deciles a little more inclusive, like more broader.
So I think a follow-up is that from the abstract, when you talk about based on the new explanation is based on the decline in the persistent earnings news, it would be nice that you clarify from the extreme to deciles, right? Just from reading a paper, I would thought all the firms has become more transitory. Yeah.
Good point. Thank you. So okay, now let me use a few minutes to explain very quickly go through the gigantic literature of the peat. Bernardo-Thomas have two papers and which basically set up the huge wave of the research on peat. So in 1989, their paper presents evidence that, you know what, this is inconsistent with the risk story, it's more consistent with the anomaly story. However, regarding what is behind this anomaly or mispricing, they raised two categories of explanations. The first set is arbitraging transaction costs. Another one is the price failing to reflect the full implication of current earnings for future earnings, basically the underreactions. And Bernardo-Thomas 1990 further explored this explanation. If we think about that, right, these two are all very intuitive, especially for the arbitraging explanation. It's like, if it's very difficult to trade on this anomaly, and then, of course, the anomaly will be there and sustain. So for the research on the underreaction or the underreaction to the implication of current earnings news on future earnings news, that also set up a big literature talking about the role of autocorrelation between current and the future earnings news. Now, if we take that and combine the latest research about the decline and the disappearance of peat, then if we think about the reason, right, and then conceptually, we would say any of these big drivers of peat in the first place could be the reason behind the decline of the peat, right? Because if the drivers is gone, and then obviously the peat can be gone, right? Now, let's still stick to the framework of Bernardo-Thomas, 1989. So they mentioned two things, arbitraging transaction costs and also the underreactions. And if we think about that, right? So this basically are two conceptually distinct aspects. The first one is if there are more trading and more trading to exploit the anomaly signals. And then obviously the anomaly, the P anomaly can be declining and the disappearance. And this is exactly what explored by the prior literature. And this makes so much sense. And I think this might be the prior for many of us at this point, is because we all know in the past several decades, there are a gigantic increase in liquidity and huge decrease in transaction costs. In other words, indeed, we do see the shift, fundamental shift behind this driver of Pete, right? Now, and in this paper, we focus on the underreaction part, which is related to the persistence of earnings news. And we argue that, you know what, this category of explanation also witnessed very big shift in the past several decades. And we argue that this anomalous signal has become much weaker. And to make this argument, we have to connect to another stream of literature talking about the overall time change in accounting properties, and specifically about earnings persistence. So I already pointed out the finance literature about the increase in operating volatility of these cash flows. And in the accounting literature, we have a string of papers talking about these things. Although they disagree on what is the driver, some people say there is economic reasons behind the decline of earnings persistence. Some other papers talk about the accounting reasons. For example, right, from a French 2004 Jeffy paper basically says that the firm that get listed in the past from 1970s to 2000s actually changed. Later firms got listed, they are much more uncertain. And then earlier firms, as a result, right, they have a lower survival rate and things like along these lines. And Srivastava 2014 JAE paper provide a similar broad message. And he shows that for the firms got listed in 1970s, 80s, 90s, 2000s, as time goes by, each new cohort of listed firms are becoming more uncertain, exhibiting higher intangible intensity, higher earnings volatility, lower earnings persistence than these previous firms listed. And there are also accounting reasons. DeChef and Town 2008 focus on the matching, right? So they say that, you know, the shift of the fast-paced approach towards the balance sheet approach make the matching between revenues and expenses worse. And as a result, they also document a trend of decreasing earnings persistence and increasing negative autocorrelation in earnings changes. On this issue, there are debates on whether that is exactly because the fast-paced approach or is because something else. So this is John McCors's paper, right, published in 2011, Accounting Review. Basically, they document that the declining trend of this earnings quality is actually because the rise of one-time or special items, and which in itself is a consequence of the increased competition in the US industries. And the rise of one-time items is also documented by Bushman, Lemon, and Zhao 2016 JAR paper. If we think about all this, right, regardless what is the reason behind this deterioration of earnings persistence, one implication is clear, right? And the conclusion is clear. You know, we later on show in our paper that we see this trend in the past several decades about the decline of persistence. Yeah, Barrett.
Hey, Wuyang. So I have kind of a high level comment, and I think that it fits pretty well right here, particularly with what you were showing on the last slide and some of the prior literature. I guess just from my read of the paper, a thought or suggestion I had was I was left a little bit wanting in design, in the sense that what I'm trying to understand, or what I'd like to understand, is you're offering an alternative explanation from the arbitrage story, right? The arbitrage, everybody can feel better now and sleep better at night because the market is more efficient type story, and you're kind of saying, oh, it's not really that, or at least it's not fully that. It's potentially this other thing. But what I'm trying to understand is whether this other thing is a good thing or not, right? So in the spirit of the accounting design project, you know, you're getting into it here. I'm trying to understand, is this decline in, you say earnings news, I don't know if it's earnings surprises, anyways, this decline in the persistence of earnings news, is it a good or bad thing? And those other papers you were citing were trying to get at that idea of whether it's kind of a good or bad thing. And I felt like in terms of your motivation, in terms of your contribution, you were kind of underselling that piece of it, which is, you know, this is a really important thing to understand, because if it really truly is a situation where the market has gotten more efficient, then hey, great. But if it's because of something else, and I don't know if it's because accounting is better or if it's because accounting is worse, like, you know, what does that mean in terms of the takeaway for why we no longer see PED? You know, you wouldn't have, I guess, any PED if earnings was a completely useless metric. So anyway, I thought that comment kind of fit in with what you were showing in that prior literature, and that was my big kind of things that I thought you guys could think about and maybe address a little bit more in the paper.
Yeah, thank you, Bart. I really appreciate this. And I totally agree that this is the part that we should have done a better job. And we have a few thoughts on this issue regarding whether this is good or bad. And I don't know whether in the end of the day, we want to go to say anything normative, like that, very explicit in that way or not. But and this, in some sense, related to the mission of the accounting design project. So the thought are the following: like, first, if our results can stand, and then we basically show that, you know what, the liquidity or the arbitrage explanation perhaps was a little bit overstated. And as a consequence, the benefits of the liquidity, you know, we can think about many regulations, not only from the accounting, but also from finance, regulations and rules. They're trying to improve liquidity, and arguing liquidity can have a lot of benefits and here and there. And so if we show that, you know what, at least in the context of PED, the benefits of liquidity on the decline of PED is actually perhaps it's a little bit overstated. So in that sense, we can have a little bit sense to say about the role of rules and the regulations on the liquidity issue. Now, second, about the persistence, right? If our story stand again, and if we show that the decline is because the persistence is becoming persistence of the earnings news also declines, and basically point out to the fact that investors' understanding of persistence is a core issue behind the PED, and perhaps behind other market efficiency issues. Now, this might be more related to Ita's earlier comment. If this is the case, then any accounting regulations and disclosures or additional information can help investors understand the persistence, can actually help improve market efficiency. But I acknowledge, you know, that is more related to Ethan's earlier comment about investors' understanding and perception of persistence rather than the persistence itself.
Yes,
I'll
just follow on just to wrap up that thought. So yeah, so if you're saying that it's not necessarily a market efficiency story, like the prevailing thought is, hey, arbitrage has gotten easier, transaction costs are lower, so the anomaly is going away because we're trading on it and making it go away. That's a good thing. And you're saying there's not that much of a good thing, but if you could do I don't have answers for you here, but to say, is it because the earnings signal is better, so investors don't underreact to it the same way they used to, or is it because the accounting signal is worse and it's just not not as relevant for future earnings and future returns? That has two different kind of implications for the takeaway. And I didn't know if there's any ways you could kind of explore industry type analyses where you could try to kind of get into that idea. Sorry, I'm sitting outside and that's a very loud truck. Anyway, like any ways to kind of get at which of those two it is. So anyway, that's how just some food for thought.
Right. Thank you. So again, these are the things that we thought about, but we don't have a very good solution. So your suggestion about doing some additional analysis, cutting on the industry, and are really good directions for us to consider. Thank you. Yeah, Wuyang?
Yeah, hi. So like, I want to follow up on what Barry just asked. I don't think that your current statistical observation regarding those two extreme deciles really kind of help us understand whether it's a measurement issue or it's a capital market liquidity trading issues, or it's actually the business economic fundamentals, right? I think what you document here is you do see there's a higher transition rate from those extreme deciles firms moving out of those deciles. Right. But whether that is due to accountants doing a poor job, capturing a lot of noisy signals in the earnings report, or it's because those extreme firms somehow operating in a very volatile business environment. Or it's because investors trading those stocks somehow have a different constraints in terms of liquidity. I think the previous slide that you summarized, those papers try to get at whether it's because the measurement accounting issues or business fundamental product market issues or try to get at what drives the changes in earnings persistence. But going back to kind of Jeremiah's earlier points, if you really want to focus on this narrow topic and this one single explanation, I think you need to go a little bit deeper to tell us what is the underlying driver, because I think right now the declining earnings news, I kind of limited knowledge, is just a statistical exercise without a lot of underlying kind of like fundamental transactions and measurement issues. Yeah. But it's just my personal experience. Opinion.
Very fair point. Very fair point. Well taken. And so at this point in the current version of the paper, right, we basically say, there is a puzzle like why the P decline, and we provide an explanation, which is the decline of the earnings news. And then we thought we don't need to go even further to provide reasons of the reason. Like we are providing one reason, which is decline of the earnings news. And should we go even further to provide a reason for this reason? And that's the reason why like we kind of stop at this point. But I mean, we might need to do more, especially as Arjen just mentioned. If we want to just focus on Pete as a narrow focus, we might need to do more on this. Fair point. Thank you. I totally agree. And this is actually something we discussed and talked among the author team. And yeah, so this is the reason why the presentation is really, really helpful. Okay, now, so let me get back to the hypothesis. Basically, from this prior literature, we basically see that it's very intuitive to say that, when the earnings are becoming a lot more volatile, and then if there's some changes, some news that would contain less information about the future earnings news. And in other words, basically there will be less implication for current earnings news, for future earnings to reflect. And as a result, we have two hypotheses. The first hypothesis is about this trend on the persistence of earnings news, and we predict that would have already declined over time, and also this decline in the persistence of earnings news contribute to the declining trend of P over time. Now let me move to the Joshua.
Yes, regarding this hypothesis, I'm a little perplexed. Maybe I didn't read the paper, I'm sorry. No problem. So I'm just trying to understand it. It seems sort of, if you assume that you have rational investors, right? So if the rational investors somehow know or estimate the persistence of news, right? So if the correlation between or among earnings surprises is high, they would expect it better. So you'd expect less speed. So it's kind of contrary to one's view of rational behavior of investors, right?
Right. So following our previous email communication, I will definitely read your paper, which provide a rational perspective of Pete, and we'll consider that in our next draft. And to your point, like at this point of the paper, we how to put it? We totally like all in Belinda Thomas' narrative, which is this is an underreaction story. In other words, it does has some element of irrationality, if we think about underreactions, right? But at least I think at least we can do is to have a discussion and about the alternative interpretations of Pete, including the rational perspective.
Since I did not read the paper, so I don't know exactly what you did empirically, but one possibility that we offer for Pete is the increase, or so the magnitude of non-information-based trading. That means sort of liquidity trading.
Right.
So I think in any empirical work, looking at that, maybe some proxy for that kind of trading would be useful, because what we suggest is that increased liquidity trading, or generally trading that's not based on information about fundamentals, caused increase in Pete. So it seems at the very least that if you can control for that somehow through some kind of proxy for non-information-based trading or liquidity trading generally.
Sure. I think that is something we can definitely do. And in case we have any issues trying to figure out how to construct that, I will ask you for help.
But because you see, logically, you'd see that if an investor knows that the correlation in unexpected earnings is high, and he's confident about that correlation, right? Observing, past sequences, or so, assuming a rational investor, so basically anticipates the same correlation as before, then he would react more intensely, and more strongly to unexpected earnings, right?
Yeah, right. I can.
So it's quite the opposite, right? It's the opposite of the hypothesis.
Again, like I think I need to read your paper more carefully to provide a better reconciliation. But at the minimum, I think what we can do is to discuss this alternative perspective of Pete and this non-anomaly based explanations. And second, we control for this non-information driven trade, as you mentioned. Yeah.
Thank you. Yeah.
Thank you. So we follow the standard set of filters and have a little more than 500,000 firm quarter observation from 1974 to 2020. And we collapse that into 185 fiscal quarters. Now, so let me quickly describe how do we measure these key variables. So for the standardized unexpected earnings, we follow the random walk model to include as many firms observations as possible. And then we sort them each quarter into deciles, and based on the SUE. And then for the top and the bottom firms in each quarter, we take the average of the buy and hold abnormal return for the second day after the current earnings announcement to the day after the next earnings announcement. And this is our standardized. And then these are our adjusted by size and book to market risk portfolios. And the hedge Pete is average buy and hold abnormal returns between the top SUE decile and the bottom SUE decile. These are quite standard. So the first set of analysis is to confirm the declining trend in the Pete. So we can see that not only from the graph, but also in the regression, we can see a significant drop, a negative coefficient on the variable trend. Okay, yeah.
Have you tried different earnings line items above IB? So I know, like you mentioned, Zhang's paper, right? Is all the persistent driven by special items below operating income, or have you tried different earnings measures? Yeah.
Right. I think I don't know whether there are others, but I know definitely we tried the operating income, and we also see the decline of the Pete. But to be consistent with prior literature, we stick to the IB. Okay, now then let's move to the core part of the analysis. So the key thing about this set,
but income before extraordinary items has changed over time because we no longer have extraordinary items in GAAP.
Oh, sorry, can you say it again? It's changing over time.
So income before extraordinary items has changed over time. So there is no longer something called extraordinary items in US GAAP.
Oh, I see. I see.
So you're not looking at the same measure.
Oh yeah, we can go back to check. So what we do, what we use is the compensate item IB, IBQ. So we need to go back to check the compensate to see how do they deal with that. But thank you for this.
They don't deal with it. They just put whatever is reported. The problem is that GAAP has changed, and we no longer have something called extraordinary items. So.
Yeah, thank you. We will figure out that and do adjustment if needed. Yeah, but even if we move up to in the income statement, and we believe the results would be robust to that. But
okay, thank you.
To be on temporarily.
Yeah. John, do you want to jump in for a few minutes?
Sure.
Or
I
Laura?
don't have the slides, so only click through them. But I'm happy to. Yeah, to answer your early question, we have tried earnings measures of the income statement. We did try operating income. To your point, I do think special items play a role in this because there's increasing special items, so that's going to make earnings less persistent. But we've done some additional analysis, not in the paper. Even if we look at observations that don't have any special items at all, we find a declining PED. So I think increasing special items, and that's both accounting and economics, is playing a role, and then even non-special items are playing a role as well. But Sudipta has a good point, because things like debt retirement, like gains on debt retirements, that used to be down in extraordinary items. Those are now in what we would call bottom line income. Technically bottom line. So yeah, I don't know exactly how we're going to address that. I haven't thought too much about it. So okay, Wuyang is back now. I'll shut up.
Well, you're muted.
Yeah, thank you, John, for covering me. And this is the benefit of having co-authors in the Zoom talk. And for some reason, my internet's logged off. Anyway, so Peter, do you have a question?
Yeah, while we're focusing on the measurement of the variables,
right?
To what extent could this result be driven by the deflator of the SU? Because basically you're looking at the pricing of earnings change. That's the SU, right?
Right. So we have a we have a market value. Okay, so you're saying the market value is playing a role here, right?
Yeah, and that's extra. Well, I don't know. It could be. It seems rather important given that we're looking at a market efficiency.
Right. I don't have a thorough answer on the ground at this point. What we did was to follow the prior literature. So I guess there might be some discussion about this issue in the prior literature. We will dig into that. But thank you for.
There are other people on the call that recall this post-earnings announcement draft literature better than I do, but price isn't the only deflator. A variance of earnings is another deflator that's been used.
Right.
And I wonder if you should consider using that.
I see. Right. Yeah, we can double check. At least we can do that as a robustness and to check the main conclusions. Yeah. Okay. Yeah. Thank you. Okay. So okay, I was here. So to measure the persistence of earnings, at the end of the day, we just focus on the stickiness of SU decile. So this is in the same spirit of Bernardo Thomas autocorrelation idea. So if the firms in decile I in the current quarter stay in the same decile in the next quarter, obviously its earnings, its SU or earnings news is persistent. Now, remember, we focus on the top and bottom decile, right, in this anomaly analysis. Then, if we think about that, then the decile of the firm in the next quarter actually has all the information about persistence, because if they stay in the same extreme decile, then it's very persistent. If it's moving away to other deciles, then it's not or less persistent. So this is the reason why we just focus on the firm's next quarter decile rank of SU. And
so you're mixing up two concepts here, because there's also mean reversion, which is a tail phenomenon, whereas persistence is a mean phenomenon. So if you have random variables through time, mean reversion dictates that just because there's some error, that when you sort on this variable, the next period has to be closer to the mean.
Right.
So, but I don't think that's got to do with persistence, because persistence is the average earnings over time, not the tails.
Agree. Is there any reason why the mean reversion is getting stronger over time?
So if you have more one-time items, then yes, that would happen automatically, right? So if you have special items one period, but not the next period, then special items take you into the tail. The next period, when you don't have it, it brings you back to the middle.
Right.
So the special items go to the tail. Right.
So I'm trying to figure out whether this is a conceptual issue or an empirical issue in the following sense. Like if this is purely, let's say, if this is purely because of mean reversion, and then should that also have a similar impact about our explanation of the P decline? And in other words, if they're part of this change in their decile rank is because of the mean reversion, that also make it make the implication of current earnings news less relevant for the future earnings news. I would think that is potentially part of our story, but perhaps I'm wrong. But I might need to think a little more about that. But I agree with you. The current way of doing this is definitely includes the impact of mean reversion. But I thought the mean reversion is also potentially part of the story that we don't need to disregard.
I think calling that persistence is sort of, because persistence is about the mean of earnings, right, for a sample. So whereas mean reversion is just about the tails moving towards the middle.
I see.
The different things.
Right. So perhaps we can clarify a little bit. Yeah. Thank you. Yeah. We need to think a little bit more about that. And then we, for each quarter, we take all the firms into top decile, and we look at their deciles, SU decile ranks. In the next quarter, we take the average, and then we call a long leg SU. And for the bottom, we call that short leg SU. And then we take the average between long leg and the short leg SU as hedge SU persistence. So just to make sure we're on the same page, right? For the firms, let me draw a little bit. So let's say this is the current quarter and this is the next quarter. So for these firms currently in the top decile, if they move down, this means they are less persistent. So the decile rank number would be smaller for the long leg. But for the short leg, if they stay in the bottom decile, this means they are very persistent. If they are moving towards higher deciles, then they are becoming less persistent. So a bigger number for long SU persistence is actually more persistent, but the bigger number for short leg SU persistence is actually means that they are less persistent. This might be a little bit confusing, and I hope I can get more clear in this slide. So let me check how much time I have. So I still have how much time? Do I still have 10 minutes?
You have like 7 minutes, so that's why I didn't stop you at this moment. 7 minutes.
Okay, thanks. That's great. Okay, so for the first hypothesis, we basically want to test the persistence of earnings news as declines over time. So we can see that see, we can take a look at this graph first. So this is a long leg, as you can see, right? The long leg, again, remember, they start as decile 10. So as time goes by, in the next quarter, they are moving downwards. So meaning that they are moving away from their original extreme deciles. Now, if you take a look at the bottom, the short leg, they start at the decile 1. And as time goes by, in the next quarter, they are moving higher. So meaning that for both short and the long leg, they're becoming less persistent. And we can also look at the difference, right? The difference between this, and you can see there is a very obvious declining trend. So this, and we can put that into regression, and we can find supporting evidence for each one. The persistence of earnings news declines over the time in the past several decades. The second hypothesis is about the role of the persistence of earnings news in explaining the declining trends of PEAT. And the way we do that is we regress the hedge PEAT on the hedged SU persistence. And as a benchmark, we also include in the first column the declining trend of PEAT. And we can find that the hedge SU persistence is highly correlated with hedge PEAT, and most importantly, right? Most importantly here, when we include the hedge SU persistence, the trend variable become insignificant, and also actually the sign swapped, and becoming the magnitude also is much smaller. And so for this analysis, we basically focus on the average for the decline in persistence for the top and the bottom decile. And we can take a different approach. We look at, for these firms, firm quarters, whether they individually show high persistence or not. In other words, for every firm quarter, we split them into two groups, whether they stay in the same extreme deciles, and these guys we call stayer and movers. Basically, they are moving away from their original extreme deciles. So we can find that the PEAT actually only exists for these stayers, right? So for the long leg, there are very positive returns. For the short leg, there are very negative returns. And there isn't much evidence about the movers. In other words, for these firms, they are moving away from their original extreme deciles. We actually do not observe PEAT. Interesting, and perhaps consistent with our expectation, is that as time goes by, we find the composition or distribution for every firm quarter, every fiscal quarter actually changes in a way that we have fewer and fewer firms staying in their original extreme deciles. Originally, in the early part of the sample, there are 40% of them, but later it's only like 30% of them. So because only stayers represent PEAT, fewer and fewer of them stay as stayers. As a result, we also see a decline of PEAT. So this is some triangulating evidence in that front. Now, let me move to the third set of analysis. I'll be very quick on this. Is
yes,
to control.
we have 3 minutes now. You can wrap up.
Excellent, yes. So we control for various net proxies of arbitraging activities, including short interest, including options and transitory institutional ownership and the market reactions at the earnings announcement. Basically, that is a price discovery around earnings announcement. We include all these. Most important, we can find that our results still hold. Now, and one possibility, we do not observe the very important role of arbitraging activities. It might be because we don't have good proxies. And then we focus entirely in the short leg, where we can use short selling activities to capture the arbitraging activities. And we find the same results, same implication that in some degrees, actually, the declining persistence of earnings news play an even more important role than the increase in short selling activities in the short leg. And we also conducted several sets of additional analyses. For all the previous analysis, we had that at the time series quarter level. We can also do that at the firm quarter level. We find similar results. And let me spend a little bit of time on this. Basically, we split the PEAT window into immediate window versus subsequent window. We view that the immediate window is more relevant for arbitrage because if you see the anomalous signal, you will go to trade immediately after the earnings announcement. And when we split the PEAT window, we actually find that PEAT at the immediate window didn't become weaker. It's actually become stronger over time. And the subsequent windows, the PEAT in the subsequent windows become weaker as we predicted and consistent with the decline of the earnings news. Okay, and our results also holds in different size cuts and using analyst-based SU calculation. Okay, so I know I'm running out of time at this point. So a quick summary of today as the key takeaway of this paper is that the key reason why PEAT decline is because the declining persistence of earnings news. And in 2 weeks from today, we'll have a bonus session of accounting design project. We'll have 2 papers talking about ESG reporting. So because we have 2 papers, we'll start a little bit earlier from 10:30 a.m. Eastern time. So we'll have Richard Barker from Oxford and Henry Friedman from UCLA. On that, thank you very much and look forward to seeing you in 2 weeks. Thank you.
If you have any follow-up questions now, you can email Wuyang. I'm sure he will be very